Welcome to the Market Enthusiast podcast, where Good Life's Noah Brooks, Chief Market Strategist, and Chris Needs, Senior Research Analyst, break down today's topics, covering their impact on the economy and personal finance in a fun, easy-to-understand way for investors of all levels.
Hey, welcome back to the Market Enthusiast. I'm Noah Brooks, and obviously this is Chris Needs.
Howdy.
So we had Nvidia's earnings that came out yesterday. How did they look?
What are you talking about, Willis?
Oh, that's right.
We are right on the precipice, though.
So Nvidia comes out tonight,
half an hour
after the bell, and here we are recording right before that happens. What do you think's going to happen?
I think we're going to have a beat. It'll be their 13th straight if they do. Just because you know how they do it. Every company manages their expectations, and they'll beat. Not saying by a mile or anything like that. Jensen had said at the end of October, I think it was maybe the day before the stock topped out, that they anticipate having $500 billion of orders in 2025 and 2026.
That's a lot of orders.
It's a lot of revenue.
All right, so they come out potentially in a half hour and they beat. Here's a better question. How does the market respond?
It's been muted responses lately, hasn't it?
Yeah.
I mean, it's been hard to beat expectations, but they're coming into it this time down about 15% from their highs, like I said, at the end of October. So this is a little bit different of a situation, right? So maybe we will get a little pop. You never know. Being down 15% already, we already know the read-through from the other hyperscalers, how much money is coming into them. So I think there's a floor underneath. I'm not saying, maybe they could go down another 3-5%, what have you, in the midst of this growth, rotation, sell-off. But I think there's a floor beneath it.
Yeah. So it hit 210 in middle of October. We're in the middle of November. It seems to me that it would be hard to get back up to new all-time highs unless something dramatic, newsworthy is talked about tonight. And maybe that could be selling to China, although we certainly haven't heard that from the administration.
Everything that we've been told from Jensen is that is not in the guidance. So You should not anticipate that in there.
Yeah. It does seem over the last month or so, I mean, the market topped out, S&P 500, and I think and NASDAQ topped out on October 29th. And S&P's down about 3.5% from there. Somehow it feels worse than 3.5%.
It does,
right?
It? Yeah.
But I mean, the market's still up for the year. Growth is up 15. Values up 11.5. Mid caps have underperformed. They're only up about 1%. Small caps, Russell 2000 up about 6%. But the S&P 600 small caps, they're actually down 1%.
Doing a little better this month so far, though.
A little bit better this month, but they're still down for the year when the S&P is up, over 12. So that doesn't really feel great. And obviously S&P driven by these big mega cap companies. In terms of earnings, 92% of the S&P 500, excluding Nvidia, have reported. 82% of those companies reported positive earnings surprise, and 76% reported positive revenue. So overall, the expectations for this quarter have jumped from about 7% earnings growth to around 13.2, something like that. So things look swimmingly, right?
But still massive ramifications here on Nvidia reporting today. So they're projecting, estimating $55 billion in revenue for the quarter, $1.25 for earnings per share.
Yeah. So
let's just get over that. Let's get a hurdle over that.
We're bringing you tomorrow's earnings yesterday. Yeah. So not a lot of economic news out there, right? We had a government shutdown, longest shutdown in the history of the United States, 43 days. Things are being patchworked back together. They've signed the bills. Parks are back open. TSA is being paid. All of the airport employees that are paid by the government are getting paid. So I feel like that's a positive thing. But it did some damage on GDP wise, right? So they're estimating about $10 billion a week. So we were, roughly 7 weeks, something like that. So it could be worth $70 billion to GDP over those 43 days.
Mm-hmm.
That doesn't make me feel great.
It was interesting, though. The Atlanta Fed's GDP now function was actually ticking upwards during it. So the last I saw, it was up at 4%. I'll be honest, I didn't check this week. But last week, it was up at 4% predicted GDP, which was interesting to see because they are the ones putting out that stat about 10 billion per day, and yet it was going upwards.
So that Atlanta Fed GDP, that thing moves around all the time.
Mm-hmm.
And quite frankly, if there was a government shutdown, how would that Atlanta Fed be operational? Huh?
It's still working, I guess. Some of them.
Well, Fed minutes came out today on the 19th. We didn't get anything earth-shattering from there. You said to me earlier that Mirren is still looking for a cut of 50 basis points, but it's pretty uneven in different Fed governors in terms of what they're saying. Because really, you see people suggesting that inflation is ticking back up, and at the same time, there's this quagmire because inflation is ticking back up, but unemployment is slowing down.
Unemployment is increasing.
Well,
employment
is
slowing
yeah.
down.
Thank you.
Yeah. So yeah, they basically in the minute said expectations for inflation ticking up, higher unemployment. So those are two contradictory things, sort of in their minds of what they can do to respond. But they still had that we had moderate strength in the economy. So interesting little, as you said, a quagmire.
Yeah.
But Mirren, still 50 basis points.
50
he
basis
doesn't
points.
care.
He doesn't care. I mean, it's interesting, right? The Fed has a dual mandate. We talked about this many times on here. So, full employment, which I suspect is anything under 5%, they'd be reasonably happy with. And then price stability, which obviously is code for inflation. So, whether inflation is, I think the number is 2.8 year over year right at the moment. That's still higher than they're looking for at their target of 2. I personally don't think 2 is an appropriate number. I mean, it hasn't been 2 in a long time. It's been, and I'm not talking about COVID era, right? Like that was 9, but historically speaking, I think long-term trend is closer to 3 than it is 2. At what point do they change their target?
I mean, yeah. Well, we always joke about how they change the inflation index for healthcare, and maybe they'll change a few more things. Then suddenly, boom, we're down to 2% inflation.
Yeah.
I don't know where 2% comes from. It's just a number that's floating out there in the ether. I mean, hey, I would say anything from 1 to 3%, like an average, which is they sort of changed their verbiage to say an average of 2%.
Well, listen, in order to get an average of 2%,
you have to go way lower. Yeah, you have to go way lower for where we've been the last 3 years.
Exactly. You'd have to have some possibly negative, some deflation to average 2%.
San Francisco Fed just had I think it was the San Francisco Fed. One of the Feds had a paper talking about how over the intermediate term, tariffs are deflationary. So maybe we'll get there because they destroy demand.
Well, that's not the way that I'd like to see deflation happen, right? So when you talk about affordability, I'd rather see prices come down than to see demand slow down.
Right.
Right. I mean, that's probably from an economic standpoint, if demand slows down, that's because people are faring worse at their home front, right?
Right.
I mean,
so let's cut those coffee and beef tariffs, right?
Well, absolutely. To be able to put a tariff on Brazil and then expect beef prices to stay the same, or coffee prices. I mean, we get a lot of coffee coffee and oranges and things of that nature from Brazil. And so then to see those prices go up and to think that they wouldn't go up when you have a 50% tariff on them seems a little bit convoluted, I guess.
Fogo de Chao, are they going to cut their prices?
Let's talk about affordability for a little bit. I mean, one of the things that people have been, politicians have been talking about over the last few weeks, and certainly people like myself as a carnivore, are beef prices, right? And when you think about beef prices, I don't go to the store and buy beef. I go to the store and I buy burgers or I buy steak. I don't think about it in other terms. And one of the things that has struck me over the years is as I've aged a little bit, I go with a higher quality beef, right? And a higher quality steak and then a higher quality beef. And I think a lot of people are in that camp where when you're young and you're first starting out, you're going to buy maybe a thin steak or a cheap steak like butcher's cut. But then you kind of, you start earning some money and you move up to, I don't know, a deli or a T-bone or, God forbid, a filet, right? And then you get to the point where you move from the butcher's cut and you move to Black Angus and then you move to prime. And so we're all out there fighting for the same limited number of resources when it comes to beef. I mean, there's only so many head of cattle out there. I read a stat the other day. Super Bowl's coming up, obviously, in a few months. Do you know how many chicken wings are consumed on Super Bowl Sunday?
Absolutely no clue. We'll call it
What do you
40
think?
million pounds.
Okay, well, I don't know how many pounds it is, but it is 1.2 billion
Oh,
chicken wings. 1.2 billion chicken wings consumed on Super Bowl Sunday. And there's only about 7.5 billion in the United States. Only about 7.5 billion chicken wings consumed. If I do my math right, and I could be wrong on this, you divide by 2 to get a chicken per chicken wings. Unless there's a new way of, unless there's a new
so you're
number.
saying there's an uptick in rotisserie chickens around that time,
Well,
or
I'm
legless
saying,
rotisserie
I'm
chickens?
saying if we eat, 7.5 billion chicken wings in a year as in the country, doesn't that mean that there has to be, 3.75
Yeah.
billion chickens harvested for that?
Yep.
Right. So when you think about steaks, obviously it's not the same thing, but everybody's fighting over limited resources. And we all want, I say we all, people have moved up market in the steak game. Everybody wants to go to a steakhouse and have one of those big, beautiful prime steaks, right? I know I do. And so we're all fighting for those limited resources and it drives the price up. Then you have a situation where there's tariffs on Brazilian steak. I don't know about anybody else, but that's going to drive the prices up. You go into store here in Reading, Pennsylvania, even a grocery store, and you're looking at a prime filet, you're talking about like $35 a pound.
Mm-hmm.
To me, that seems expensive.
Yeah.
From where it was pre-COVID.
Yeah.
Right?
I agree.
But I'm a carnivore. I'm not going to stop eating steak. I may, and here's where that whole idea of price elasticity comes into play. Do you slow down? I know that we have slowed down. I mean, there's a probably more than one reason why. It's just not the dollars and cents of it. It's because I don't need red meat every day, right? But
so your doctor says.
So my doctor did actually say that. I went in. I said this to you the other day. I went in, had my checkup. He says, "Well, your triglycerides are high." I said, "Okay." He goes, "Well, do you eat a lot of red meat?"
Oh yeah, doc. I'm good. I'm good there.
Well, it's like a scotch and a steak. Is that bad? He goes, "Well, those are the two things that you want to lower, you want to reduce to bring your triglycerides down: alcohol content and red meat." Oh, and ice
you
cream.
Thought you were ahead of the game. You did your homework. You're already doing it. And he said, like, no, don't do that.
Yeah, he definitely did not want me to eat a scotch and a steak. He did not. He did not think that would be beneficial in reducing the triglycerides.
Yeah.
Yeah. No. I guess it's just one of those things where, there was probably a little bit of a balance, and I don't mean in health wise, but in that price elasticity. So if it goes up from here, will I slow down a little bit? I suspect I probably will.
Because you're making a healthy decision.
Yeah, because I'm making a healthy decision. But I mean, affordability is certainly an issue. We had some elections a few weeks ago, and that was one of the main things that Democrats were driving home was affordability. And I suspect that that's going to be a continued piece of the political puzzle. I mean, it always is, but I think it's going to be more and more pushed. One of the things that was talked about, and I'm sure a lot of people out there have heard this, but the idea of that 50-year mortgage. What do you make of that? As an affordability
yeah.
helper.
So what I'd say, I like what like Robinhood is doing by democratizing everything, giving access to everything. Like you're bringing in the prediction markets and all these things. I like that. But just because you have prediction markets and stuff on there doesn't mean you should be doing that right next to your IRA and stuff like that. I think it's the same thing here with the 30 and 50-year mortgage. Just because you can do a 50-year mortgage if it comes to pass doesn't mean you should. The stats don't look good when you do that. I think we were looking at a $500,000 loan at 6% at the 360 payment mark on a 50-year mortgage. You would only own approximately, I think it's a little below 30% of the home, meaning 30% of the principal paid off.
Yeah.
Versus you would have the whole home and you would just owe your property taxes, which I also hate.
Well,
in a 30-year mortgage.
I don't think you're going to get.
But the point being
taxes.
is, I think you have the stats on the interest difference, but it's massive.
Yeah, we looked at it earlier, and on the 30-year mortgage on a $500,000 home at 6%, which is probably a little bit lower than the average today. I think the average is around 6.3 right at the moment. Just the principal and interest, not the full payment, but principal interest for $500,000 at 30 years is going to run you, let's call it $3,000 at 6%. On the 50-year mortgage, it's going to be about $360 lower, $2,633. And so I get that $360 difference, but you're talking about an interest difference of around $500,000. So that 6% at 30 years is going to run you roughly $500,000 in interest. And on 50 years, it's going to run you approximately $1 million in interest. And so I'm not convinced that extending the payment structure on a house is the way to bring in or to help affordability.
Just because it's cheaper on a monthly basis, monthly payment, doesn't make it more affordable.
Yeah, it seems penny wise, pound foolish type of scenario. Yeah. So here's what I want to come up with, or here's my suggestion for the administration. And tell me if you think this is crazy or not. So to help affordability, a lot of times when you have a new home buyer or even a second or third home buyer, one of the biggest issues is that down payment, especially, a $500,000 house. You want to get rid of that mortgage insurance. You're going to need to come up with $100,000. So here's my idea. Don't call me a commie or socialist or any of this nonsense, right? What if instead of 50-year mortgages, the government lent you at a reasonable interest rate, say 0, the 20% for your down payment? And it's not just a loan, but they're actually a co-owner in the house with you where they have first lien mortgage on that first 20% down payment. And when you sell it, they get paid out. If you're really talking about affordability and how to get new home buyers into homes, that to me seems to be the easiest way. And I say easy. With technology, we should be able to have those mortgages out there. But I said this to a few different people, and they said, well, that sounds like you're a socialist.
Them being first lien holder, like if you go belly up, then the government owns the house.
Well, they own that 20% or the down payment or however
and
much
the bank gets the rest. If you get foreclosed on.
However it would be normally, except the government gets their money back. If you sell it, the government gets their money back. To me, that doesn't seem like socialism. It seems like
communist,
right? It seems like a way to help new homeowners. And I'm not saying that you can do this for everybody in every income bracket. You don't need the government buying 20% of a $20 million house. And I don't think it should be just first-time home buyers, but maybe houses indexed for the state that they're in, and have $1 million be the limit, but based on whatever state. Obviously, it'd be higher in California, lower in Oklahoma. I don't think it would be that much of a lift from a tech standpoint. I don't know that you could get Congress. I don't know if there's an appetite to do it. But when you think about what Biden tried to do with paying off student debt, just paying it off. That's not this. This is lending money and investing in American properties as a first lien holder to help people get out of, I'm going to say parents' basements. I don't know anybody that's living in their parents' basements today, but to help people buy homes, to get out of the rental market and to own, whether it's their first, second, third home. The taxpayer is not on the hook for this. The Federal Reserve can print as much money as they want to. We already do.
Yeah.
I mean, they print it for everything else. Why don't we print it to actually help American home buyers?
Yeah. I mean, that's definitely an option. I just think of something simpler for first-time home buyers, like they do a subsidized rate of 2 or 3%. I think it's just easier. I think over the long term, it makes out better than even a down payment in at the market rate. So it just comes off as a one time, you get one shot at this subsidized government loan for your first home buying,
But then
2 instead of 6%.
But then you have a situation, Chris, where you and I, the taxpayer, are subsidizing somebody else and the banks are still making the money. In this case, that 20% down payment wouldn't go to the banks. They're not going to make any money on it. They're still going to make their money on that 80%, right? But I'm not paying a bank interest as a taxpayer.
Yeah.
And that's what I really
You don't
care
like
about.
banks?
No, I mean, sure, I love banks as much as the next guy does, but I don't necessarily want to subsidize everybody else's mortgage with my tax dollars. Just giving them the money.
Well, 2% rate, the government's going to end up owning it anyways. Like, they'll just sell it. Fannie Mae, Freddie Mac.
But it still requires the bank to be paid the difference between the subsidized rate and the actual rate. And that's the part that I wouldn't want to do. I don't think it would work.
I do not envy people of age coming into, just graduating college. I feel like it's a tougher market, job market. It's a changing job market with AI, right here on the horizon. College has grown at a significant rate, of higher inflation than other goods. And then houses have gone up 2x in the last 7-8 years. And over that time, interest rates have gone from their lows to now they're up 3 times what they were. Definitely not a good time to be in. I'm glad I got in before that rush.
Well, I'll tell you what. I mean, my first home in 2002 was at a higher rate than the average rate today. We got in at 8.75%. But the first house I bought was only $80,000. I mean, so there's a big difference. I don't think in 2002, well, I know in 2002, I wouldn't have been able to afford I think the average house price throughout all of the United States is 404 or 444,000. I wouldn't have been able to afford that.
You did not go full boomer there because you're not boomer. But I just find it so rich when boomers do pull that, like, well, when I got my first house, it was an 18% loan. Well, yeah, the charts show in terms of median income to buy a medium priced house, we're at the highest levels ever.
Yeah.
So no matter what your interest rate was, the cost was so much lower that you were not paying 44% of your income to be in that house.
Yeah.
It's unfortunate, and we do need to figure it out because I think that's going to unlock money for the economy as well. And people deserve a home. I mean, you're not owed a home, but people deserve a chance at a home. We need to build more homes.
Yeah. I think one of the things that happened,
maybe we need to do some sort of tax credit for home builders, subsidizing some more capitalism.
I don't know about subsidized capitalism. That doesn't seem 100% to me. How about
if it hasn't been done before?
Right. Yeah. Intel. How about just making it easier for homes to be built? I mean, we really had a massive, we had a massive slowdown after the global financial crisis. I think pre-global financial crisis, we were annualizing at about 1.6 million new homes. After that, like 2010 and 11, it dropped to under 400,000, and it's worked its way back up. But we never made up for that lost time in terms of homes, and people were still having kids and growing up, and life continues, and we're at a home deficit in terms of what's available. If you travel to Europe, that's kind of a similar situation over there because they have so much red tape and so little open space. That's why their prices have gone up dramatically. Ours have gone up dramatically, a number of reasons, including that. But the red tape is definitely there.
Yeah.
So maybe centralized planning, right? That's a little socialism there. No, but we need to do things to encourage home ownership.
Mm-hmm.
And in order to encourage home ownership, you can't just tell people to go get a new mortgage at, $3,000 or $4,000 or $5,000 a month. It's not going to happen. You've got to be willing to put something in there to build new houses, because that's what's that's one of the main keys in what's driving prices up.
Totally agree.
Either that or another global financial crisis bring prices down, right?
Who knows? With our demographics, we're probably heading back to, in 30, 40 years, we might have a lower population in the U.S.
Yeah.
Based on birth rate.
What's the replacement rate to keep population stable? 2.1? And where are we now?
1.9?
Yeah.
Something like that.
I mean, you play that out over a long period of time.
Yeah.
If we have reduced immigration, however you particularly feel about that, reduced immigration, a lower birth rate. Did you ever see Idiocracy?
I have seen parts of it. I know the entire premise, and we're here.
The beginning of that movie is all about the birth rate. They set that up to tell you how that happened, and all the, as they described it, lower IQ people were having tons of babies, and all the smart people were not. They were waiting.
It's weird. That's like, never mind.
All right, so we touched on affordability. I mean, do you have anything out there that's going to change the way people spend money and what they spend it on?
I don't know about that, but I'm big on the AI causing deflation over the intermediate term.
Play that out for me.
So we're going to have much more efficient capital being productivity is going to be way up, which automatically is deflationary. In the simplest form, that's what I see.
But doesn't that also mean that profits will go down?
Not necessarily.
You're
the
saying
productivity is going to outpace to such an extent. Like, you have your normal $15 an hour person, or you can have a robot that's one time 20, 30 grand to do the same job. And you don't have to pay for healthcare for that robot. So over a 5-year thing, it costs like $6,000 a year. And they do the same exact job with maybe higher quality. They're more reliable. They don't get sick.
Robots don't get sick?
Don't think so. They may have to download some firmware or something, but...
You're a big proponent of universal basic income then?
Eventually. Eventually.
I mean, do you really think that that's the way it's going to go?
I think we will farm out our robots. I'm going to buy 2 or 3 Optimuses, and they're going to go do some minimum wage job. They're going to drive my Tesla around and pick people up.
But isn't the Tesla supposed to drive itself?
Yeah, but it needs a safety inspector. That's my robot.
I don't
need someone to plug in the charging cord, Noah. I'm going to not get into the Uber thing where you pay them a cut. I'm just going to have my robot do it. You'd just be sitting at home anyway. This makes sense. Trust me, I thought it out.
So
I'm going to have 5 Teslas and 5 Optimuses.
I know some people that actually run an Amish Uber here in Pennsylvania. No, I'm dead serious. I know some people that live closer to the Amish country, and they run an Amish Uber. There's no technology except a cell phone, and it's in the Amish community, and they just drive Amish people around when they need to go somewhere.
Don't the horses do that?
Well, I mean, I guess they do, but if you don't want to take a horse, you can just hop in an Amish Uber. It's a real thing.
So the horses are equivalent to my Tesla.
I don't know. I don't know. There's a driver in this scenario, though. It's a
Okay.
real driver. It's not a robot or anything.
Okay.
It's a real person and real Amish people in the back, I guess. Yeah.
Just wait until there's like future smart children, like 12, 13-year-old hacktivists who hack into like a Tesla car and they're like driving from their game controller in their room and they start crashing.
You talk about hacking. We started watching 0 Day, Robert De Niro. Have you seen that?
I've seen the first 2 episodes.
Oh, you did?
Yeah.
Okay. What did you think the first 2 episodes?
I see a number of angles that it could be playing towards, and I'm wondering which one they're going to go down on.
Yeah. For the uninitiated, I don't think there's any spoilers here. Essentially, there's a 1 minute time frame where all the technology in the United States goes down. That's the first episode. So everything goes down, all the cell phones, and then there's this little message that pops up that says, "This will happen again." A lot of people died. Some airplanes crashed in the show, and I mean, it really gets you thinking. We watched it as limited series. I think it's 6 episodes. I didn't think the ending was spectacular. Kind of bobs and weaves a little bit, but the idea of everything relying more and more on technology, and when that technology goes down, that seems to be a trend that's popping up, and maybe I'm only noticing it now. I guess it maybe have been in movies for years and years and years, but it seems like the closer we get to technology, the more this is popping up in storylines. And at some point, I mean, we had was it Cloudflare down?
That was this week, yeah.
Yeah. You're starting to see that.
CrowdStrike was a couple years ago.
Yeah. You're starting to see that pop up, and you get these emails from your vendor that's like, "Hey, I'm sorry, we're down today because of this other vendor that we operate through, and we'll let you know when it's back up." And you're like, "Huh, okay, well, what do you do?" I mean, as an end user, I can't do anything.
Mm-hmm.
If that were to happen the way this 0 Day lays it out in there, I mean, we're essentially all at the mercy of these hacktivists, as you said.
Mm-hmm.
I don't really see a way around it except living off grid, right?
Yeah, basically.
Yeah, I don't think they have prime out in the woods.
No.
Prime venison, maybe. Not any prime fillets from any beef.
I've been watching those people online, like the reels of the people who just build a shelter by hand. So cool. I wish I could do that.
A 30-second video, and you're like, "Oh, I could do that.
Easy."
Yeah, I'm not sure that it works like that. Well, at some point, maybe we have to slow down on our beef intake and our carnivore intake, and maybe we're just eating pasta. But here's what I heard about pasta the other day. This is no lie. I didn't hear it on Facebook or Instagram or X or any of those things. But apparently there is 100% tariff that is coming on imported Italian pasta. And that a lot of suppliers are going to just stop stocking it here in the United States. This is real. You can look it up.
This is not my like San Giorgio stuff, is it?
Is that
like
Italian?
Knockoff. I mean, the name is, but I assume it's not.
If it's coming from Italy, there's 12 major pasta manufacturers that produce pasta in Italy that ship here to the United States.
Why are they getting some from China? What's the deal here? Why are we doing 100% on that?
They're accused of dumping pasta. Like they have so much of it.
It's like 90 cents anyways. What they?
It's a real thing.
I thought we were trying to lower prices, Noah.
I thought that might
Come on.
I thought that might be the case for affordability as well.
Pasta for everyone.
Do we have a lot of American pasta manufacturers out there? I'm sure there's some.
Barillo, San Giorgio. Well, I don't know which ones are U.S. and which one are Italian. I just assume the ones I'm buying are U.S., but it's a bad assumption.
I don't know.
I don't check the tag.
You're going to get like grocer's pride. That's the only thing that's going to be out there after this whole thing happens.
Oh, well, I could do without pasta. Lex loves pasta. I don't. Lex is Italian, but me.
You don't do pasta?
I will just eat a plate of meatballs or sausage or something or chicken parmesan. I don't need the noodles. It's just filling.
Okay.
I don't need the pasta.
So as a consumer, our consumer spending equates to about 68% of GDP. And so I think what we're seeing right at the moment is this scenario where there's this balance between, are consumers healthy or are they in the midst of a slowdown? And that seems to be what everybody's concerned about in the market. I said earlier we were down, 3.5% from all-time highs. That's not a thing, right? Okay, that happens all the time. You can't just be at an all-time high forever. But you're starting to see layoffs, right? We talked about Amazon laying off 27,000. Came out since last time we were in here. AT&T's laying off 15,000. And maybe that is, overhiring in after COVID. Maybe that is, hey, we're just becoming more productive through artificial intelligence and robotization of processes. Or maybe it's, hey, we really need to get our earnings in place and make sure that we're right-sized. They love that word, right-sized. But you start to hear these things, and then you think about consumer spending, and you think about the productivity that you mentioned for artificial intelligence, and you really question, are there going to be more jobs out there? Right now, we're a little over 159 million people employed in the United States. Are there going to be more jobs next year or in 2 years than there are today? We need 70,000 jobs a month to maintain that 150 million jobs. That's how many people leave the workforce every month. And as the Fed noted, we don't have any data on that for the last 2 months. And the jobs numbers that are come out, the survey is always taken in the week in which the 12th day of the month falls in. And we were closed over that week. The government was closed. That was last week. So we may go another month.
I think December 16th, they said we'll get the next jobs data.
Yeah.
December 9th on JOLTS.
But we may go another full month without the jobs numbers. Now, some people say, well, it's a survey, it doesn't matter anyway, but that's what we're going on right at the moment. So Federal Reserve is going to be flying blind. We had that Challenger Christmas report came out, said there was 100,000 more layoffs this year over the month than it was last year. The ADP numbers were kind of flip-flopping between negative and positive. I mean, it's going to be a big tell when they come out with that first number.
I figured they're leaning towards keeping an eye on the labor market more so than inflation, just because what's the matter if you're paying a tenth higher for something versus not having a job? But you saw those minutes come out today, and it didn't seem like there was many dovish folks. So I don't know. I would say with that weakness, you would expect another 25 basis point cut. It's not a huge cut. It's not like they're going 50 or 1% or something like that. But there's people dealing with a softening job market for sure.
Well, going back to the Fed, I mean, they're stuck in this quagmire. If unemployment goes up, but inflation also goes up, right? We would call that stagflation, I guess, if GDP is not rising at the same time, which it could.
Mm-hmm.
I mean, it's not binary like that. You could have all three things happen. I don't suppose it would happen, but it could happen. What would they do in that scenario?
They choose which one to prioritize.
Which one do they prioritize? That's a dual mandate.
Which one? No.
I don't know.
I would lean towards the labor market.
Yeah. Yeah, that is But
I'm not
question.
sitting on the FOMC. So.
No, neither am I, obviously.
Eventually there's going to be an issue where it doesn't matter what they're doing because of, like I said, AI and robots, where there's going to be a crossover threshold where the whole labor situation is going to change, where, historically, you look at the production function, there's your GDP on one side, there's technological process, there's labor input and capital inputs, and eventually capital is going to be equivalent to the human labor quantity aspect, because robots are going to be able to do just what we're doing. So they'll have to figure that out.
I'm telling you, HVAC, plumbers, mechanics, auto mechanics, they're going to have jobs for a long, long, long time.
Yep.
Anybody that comes to your house, they're going to have a job for a long, long, long time.
That entry, not so much.
Yeah. Yeah. Research analyst.
Hey.
You're not, come on now. But no, like an entry level research analyst in the medical field, I don't know.
Yeah.
That can all be done. That can all be automated these days. There's no question about it. I guess if you fast forward that and you think, okay, well, now you have, I don't know, 20 million people, 30 million people that are on universal basic income. What are they going to do? And I mean that quite literally. Like, all
Go
of a sudden,
live in the Matrix.
well, yeah, but so you have income coming in, you don't have a job. What are you going to do with yourself? Everybody's going to be
find a hobby.
self-actualizing.
Maybe they can do their own little garden and feed themselves then to make up for it.
To make up for what?
Not having a job. And universal basic income is going to be like Social Security. It's not going to be enough to truly live off. It's just going to be a supplement to make your life a little less bad. To say that, yeah, a robot's worth more than you to that company.
Are we going to tax these robots?
Companies get taxed on their profit, which their profits should go up because they're more efficient. So maybe the tax rate could bleed upwards because they're more productive to pay for the UBI.
Less workers means less Social Security. Doesn't mean less UBI.
That's going to be gone in 10 years anyway.
Boy.
So
don't say that.
Sorry. It's going to decrease substantially.
I'm not going to get a lot of Social Security, but I'd like to get what I'm entitled to.
You'll get what you get, and you'll like it.
Okay. You
70%.
You don't think you're going to get any?
I'll get maybe 40% of what the current people are getting. It's going to scale down like that. It's going to go down to 70% in 2034, 2035. Then eventually it's just going to go down till it's gone.
I don't think it's possible.
They should have been in equities.
Well, they should have been in equities. What were they in, Chris?
They were in treasuries, fixed income only.
Yeah, that doesn't make a lot of sense.
No.
Maybe they should have been in Nvidia.
Just imagine we'd all be funded then. Maybe we could get 120% of SSI the next year.
Yeah, maybe. All right, as we're wrapping up here, what else do you have? Anything good?
I would just recommend anyone checking out that Warren Buffett letter. Warren Buffett put out, I guess, what could be his last annual shareholder letter.
It is his last annual, yeah.
To me, it read as like the spark notes of a future biography and what will be a very researched person, undoubtedly. He talked about all his connections with Omaha, obviously, and all the amazing people who were in insanely close proximity to him. Obviously, Munger lived a couple streets away, which he didn't know because Munger was a few years older than him. The CEO of Coca-Cola, Don Keogh, was his neighbor. Obviously, he made huge investments in Coca-Cola over the years. Stan Lipsey was his name. He was one of the early people Buffett invested in, turned around Buffalo newspaper and made Berkshire a lot of money. All these people that just happened to be living in Omaha. So it was very interesting. He is a great writer, and we'll miss his annual letters.
Yeah. I don't know that I shouldn't say that he's not cracked up to he's not all that cracked up to be. What's the expression? I don't want to dunk on him in any shape or form. I started in the business in the 90s, and he was, the Oracle of Omaha back then, and his lure has only grown. He was one of the guys that actually helped bail out long-term capital management in 1998 when they went belly up because of the Thai baht, Russian ruble. And, at the time, it was a massive undertaking. Looking back on it today, the bailout of long-term capital management and Buffett putting that together with some other big banks, it was only about $500 million.
And
I
he
say
got a sweet
only.
deal, just like with the great financial crisis. He got a sweet deal on Bank of America, etc.
Yeah. So he has done an amazing job. And there's always been, I guess, a little bit of a Buffett premium in Berkshire. I would take the other side of that and say that maybe, yeah, okay, it's warranted. He's stepping down. I would take the other side and say that they might be a little bit more aggressive without Warren Buffett there.
We've already seen that a little bit. I mean, he's not gone yet, but clearly there was a recent purchase of Alphabet that probably didn't come from Warren's desk.
You don't think he would? He
No.
would buy?
He
buy
said
some?
he missed out on Google way back when. Obviously, it's a great business, but yeah, we're seeing a little bit of that already. His greatest skill was his impulse control and his I think, comfortability with not doing things, which saved him a lot of money and gave him opportunities down the line when things hit the fan.
Yeah.
He didn't blow up really in the .com bubble or anything like that.
He didn't understand the internet at that time, and he didn't invest in it. And so he missed some of the run up in the late 90s, and then he completely missed. I mean, the Berkshire was down when the rest of the market was down, but it wasn't down like
50-60%.
pets.com.
Whoa, one random thing at the beginning of the letter, he talked about when he was a child in like the 1930s and when he had appendicitis. And did you read that part? He was talking about how his dream at that time. So what he did, he was at like a Christian or a Catholic hospital, and it was worked by all nuns. And he said he was convinced that nobody would ever fingerprint nuns. So if they committed a crime, it wouldn't be in the FBI database. So he went around and fingerprinted all the nurses on his floor. And he just figured someday J. Edgar Hoover would come to him and say, "Thank you, sir. You solved this crime. Whoever would have done this and documented the fingerprints of these nuns. You solved this crime."
Fingerprinting nuns. Yeah. Fingerprinting nuns. That's hysterical.
Yeah. What a guy.
What a guy. For anybody that's still listening, Connor is out there running
the Great World Race.
The Great World Race, which is 7 races in 7 days in 7 continents. And I've been following, obviously, him and his trials on Twitch. Today he was in Portugal. They had flown in from Abu Dhabi. He raced in Abu Dhabi. He did a 4:06, 4 hours and 6 minutes in Portugal. They hopped on a plane. They're on their way right now to Cartagena, and they're going to be winding up Friday for the 7th marathon in 7 days in Miami at 7 a.m. So that's the Great World Race on Twitch. If you're interested, you can always see updates on LinkedIn. You think he's going to do permanent damage to his foot?
Yeah, he's running on a stress fracture in his foot.
A little bit nutty.
Yeah, I don't think I would do 1 marathon on a stress fractured foot, let alone 7 in 7 days in 7 continents.
I wouldn't even want to do the flying in 7 days, let alone the running.
Yeah,
to me. All right, that's it for everybody here. Appreciate it. We will see you next time on the Market Enthusiast. Thanks for listening.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.